Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is 9 a.m. Saturday, July 9th, and we are doing a deep dive with the students in my course, How to Get Started One Rental at a Time. This is our third of many deep dives. The beauty about this is, yes, we do this live with my students. We give them, allow them to ask questions in real time, but we also post this on YouTube. So you will see this on YouTube later this weekend. What we're going to talk about today is cost segregation and bonus depreciation. We have the one and only David Weiner, who personally helped me save $10,000 last. That's real money, not just, a top line tax deduction, 10 grand. So David, you are my friend. Anybody who saves me 10 grand is my friend. I just want you to know. Why don't you take it over?
I'm hoping I'm going to save you more than that.
Yeah, well, absolutely. You and me both. You and me both. So why don't you take it over? You have a quick kind of level set, because again, we're going to put this out in YouTube world about what is cost segregation. It's only 5 or 6 slides, but why don't we get into that first while people input their questions?
Super. Happy to do that. Let me get my screen up here. And there we go. So I'm finding that a lot of people are not familiar with cost segregation. It is basically an approved process in the US tax code of analyzing and identifying property, both commercial and rental residential property, certain components of which are eligible for accelerated depreciation. So what that means is when you buy or build rental residential property, typically, the way that it's handled is it's depreciated over 27 and a half years. So the cost of that building, not the land, just the building, is divided by 27 and a half. And every year, because buildings wear out, you can take that amount off of your taxes as depreciation. That's the standard way of doing it. But through cost segregation, what we do is we identify all the pieces and parts of your building, a lot of which, according to the tax code, can be depreciated much quicker, 5, 7, or 15 years. And by accelerating that depreciation, we get you larger tax deductions toward the front end of your ownership. The result of a cost segregation study is you get to save income taxes. You get lower income taxes in the first few years of your property. Right now, because of the Tax Cuts and Jobs Act in 2017, not only do we have the ability to do cost segregation, we also have what we call bonus depreciation. Bonus depreciation says, and it was created by the Tax Cuts and Jobs Act as a stimulus for people to buy commercial and rental residential property. All of the 5, 7, and 15-year property, while we have 100% bonus depreciation, can be taken 100% the first year. So all of that non-structural part of your property, you can write off the first year, which gets you a huge tax deduction, like we did for Michael. This is just a cost segregation study is an input calculation to the US tax code, and it's based on building systems valuations. That's technical. We'll handle that. But it allows you to use cash today instead of leaving it with the government for 27 and a half or 39 years. We don't give you additional depreciation because you can only depreciate what's there. It's based on what you spent on the property, not what the current value is, but what you spent on the property. And we segregate personal property, which is everything in the property that is non-structural, and we separate it from what they call real property, which is the structural parts of your building. According to the tax code, there are about 6 different ways of doing cost segregation. There is one method that is preferred by the Internal Revenue Service. They call it the certain method of depreciation, and that's engineering-based cost segregation, because we actually take pictures, we take measurements, we get actual documents, and it's run by a team of engineers that do all the breakdowns. So it is the certain method of depreciation. There are other ways of doing it. I wouldn't recommend any of them. We can do a cost segregation study on any buildings or tenant improvements as small as $200,000 in cost that have been owned for less than 15 years. Once it gets past 15 years, you could still do a study, but the benefit isn't going to be that great. And the benchmark on a cost segregation study, just so you're aware, is $30,000 to $80,000 off of your taxes per $1 million in cost over 5 years, or while we have bonus depreciation, immediately the first year. Starting at the end of 2022, any properties purchased in 2023 or built in 2023 will only get 80% bonus depreciation. So we figure out all of that stuff that can be accelerated, 80% of which you can take the first year, and the other 20% is divided among the first 5, 7, or 15 years. In the following year, it's only 60%, then 40%, then 20%, then 0. So let me move forward here. What is 5-year property? What is non-structural? Well, your 5 and 7-year property are any interior doors, any movable wall partitions, any decorative building elements, wall coverings, any special electrical, plumbing, or mechanical, your carpet, your flooring, your decorative moldings, your built-in cabinets, your countertops, security systems, decorative and special lighting, any window treatments, window coverings, communications, cable that you run, kitchen fixtures, any refrigeration equipment. All of that stuff falls into the 5 and 7-year property, according to the Internal Revenue Service. And so as we get in, one of the reasons we take pictures is there may be things that we don't think about, but we see them in the pictures and we know, hey, this is something that we can actually accelerate in depreciation. 15 years is basically land improvements, your landscaping, your hardscaping, paving, fencing, utilities. If you have a parking lot or, in commercial, a parking deck, any signage that's there, sidewalks, irrigation, any of that stuff is considered to be 15-year property. Generally, it works out so that about 20 to 30% of the property in most cases can be accelerated, and with bonus depreciation can be taken immediately. A lot of people ask me, well, if I do the cost segregation with bonus depreciation in the first year, then will I have no depreciation to take in future years? Everybody looks forward to that deduction. That's not true. You will still have depreciation to take, and a good bit of it. So in this graph, the blue line represents straight line depreciation. If you just divided it out by the life of the property, rental residential property is 27.5 years. Short-term rentals are treated like a business and treated like commercial property. They're 39 years, and commercial property is 39 years. By doing bonus depreciation, cost segregation with bonus depreciation, you get that big deduction the first year, and then every other year for the total life of the property, you get a depreciation deduction, but it's just a little bit less than it would have been if you were doing the straight line depreciation. At the end of the useful life of the property, it all kind of works out. However, the benefit of having the money all up front means you can put it to work. And if you put it to work and get a return on it, you'll create a whole lot more money out of that as well to use for yourself, for whatever you're going to use. So I thought I'd include just a few of the, just some case studies of some properties that I've done. Here's a single family home. The cost of the building, not including the land, was $250,176. After doing the study, the tax savings benefit was $32,845. That's cash off the taxes. The cost of the study was $2,420. That study fee is also tax deductible as an expense. And so the after-tax study fee cost them about $1,500 to get almost $33,000 off of their taxes. The return on investment was 21-1. And if they took that tax savings benefit and they put it back to work and it earned an 8% return on it, which is not crazy, that's a decent return. The future value of that $32,000 savings by the end of the property is $449,976. We did a condo, which was a short-term rental. The building cost was $324,000 for the condo. This client of ours saved $52,856 off of their taxes in that first year. The study fee was $3,400 after tax, just a little over $2,000 to get that $52,000 benefit. The return on investment was 24-1. And if they put that money to work, the future value of that money at 8% over the life of the property was $724,127. Did a single family home in the nice neighborhood.
Mhm.
It was a $1.2 million home. Not the most expensive home I've done, but this one worked out real well. They got $339,500 off of their taxes. If they put that to work, and the study only cost them $5,900 after tax, $3,774. But if they put that money to work, which I know they did, and reinvested in their real estate business, it'll have a future value of $4.6 million by the time that they're done.
Hey, David, I just want to make this point very, very clear.
Yes.
In these three examples, none of these, in fact, you can't do this on owner-occupied houses. These are all
Correct.
rentals. Either
It has to be income producing property.
correct.
Now, if you're house hacking a duplex,
Mhm.
you can do cost segregation on the half that you're renting,
Correct.
but you can't do it on any personal property
Correct.
that you own.
I didn't want somebody to see the $1.2 million home and assume that was owner occupied. These are rentals producing income.
To be honest with you, I'm working on one right now in Beverly Hills.
Oh,
The house cost, I think it was about $3 million, and the lady put in $1.5 million in renovations before she felt like she could rent it.
oh my goodness. Some people got a lot of money. All right. I'm sorry. I just wanted to make sure nobody.
Not a problem. That's what I've got. The rest is just, if you need to get in touch with me, here's how you do it. And we can leave this up for a second so people can write that down maybe. And
yeah, and this may end up on my podcast, so let me read it. If you are interested in cost segregation, bonus depreciation, you want to get a part of this, I strongly suggest you text David at 770-367-8091. You could check him out, David Wiener at .costsegregations.com. That's a site, and has his YouTube channel, Cash Flow Strategies Inc. So we will leave that here. Let me see if I can bring up chats. Oh, I can. How about that? All right, folks, remember, this is for you. This deep dive is for you. I've already been through this once. So we're going to go through the chats while we actually, can I move this? Oh, look at that. I can move it too. Like I've done this before. Oh man, I'm so cool.
pretty cool, huh?
So Caesar, good morning. How are you? Kenny, thank you for letting me know the sound was good. Let me scroll down. No audio or just me. Oops. Hopefully you guys can hear us. Good morning. Good morning. The slides say commercial and residential building isn't applicable to single family homes. Caesar, hopefully you've seen that. We gave them single family home examples. They have to produce income, right, David?
Yes, they must be income producing properties. Unfortunately, you can't do it on your personal residence because you don't depreciate your personal residence.
Oh, here's an interesting question that we can dig into together.
Okay.
What's the ideal value of a property to do a cost segregation on?
There's really no ideal value because anything that has a price of 200,000 and up, or a cost basis without land, you may or may not know that, of 150,000 or up, is a good candidate to at least get a free estimate on it to see. Then you have some objective numbers to work with to see if it's worth doing it for you.
Mm-hmm.
We probably also should mention, Michael, how this can be applied.
Mm-hmm. Go for it.
Because if you are with a long-term rental, if you are not considered by the IRS as a real estate professional,
Mhm.
and it's not easy to be considered by the IRS as a real estate professional. If you are not considered a real estate professional, the depreciation that we generate can only be used against passive income.
Mhm.
Now, it can be used against your total passive income, not just this property, but only against passive income, unless your modified adjusted gross income is under $150,000, in which case there are some limitations to the passive loss that you can use. I can figure that out, help you figure that out as well as your CPA can as well.
Mhm.
If you are considered a real estate professional, then the depreciation that we generate can be used against your total income. So it's a great advantage.
So
If you're doing it,
go ahead.
I was going to say, if you're doing a short-term rental, it's treated as a business rather than a residential rental. Therefore, if you are actively involved in your short-term rental, you can use that against your total income as well without being a real estate professional.
Yeah. So I want to follow up on that, but I want to go back to because there's a lot of folks that are on my channel, follow me, that their adjusted gross incomes exceeds 150 grand.
Sure.
Right? It just does. And as you know, and I know, having had it happen to me for 15 years, because of that income threshold, I had to do what's called a carry forward loss. I think I'm saying that right.
Yep.
So basically, I had all of these losses that were greater than my passive income. So again, I never paid taxes on my passive income, but if my write-offs were greater than my total income, I only could take it to zero. And then anything I didn't use, I carried forward.
And you can carry it forward virtually forever,
right,
until you use it.
Yeah. So again, I did use it once I became a real estate professional after I left my W-2, and I had some very good years where I was wiping out the carry forward. But that is something to consider. Like, one of the things, like, let's just say you make 200 grand a year, you're an engineer, you're a dentist, you're a doctor, lawyer, small business owner, whatever it is, you make 200 grand a year, and you just bought a fourplex. Well, if it's your only unit, and maybe in a fourplex, you just bought it, you cash flow, I don't know, let's make it up, $1,000. So you're only going to cash flow 12 grand a year. Frankly, David, the straight line depreciation is probably going to wipe that 12 grand out without this.
Yes.
Yeah, probably. I mean, let's just be real, right? So these are things that you need to think about. But what I would tell you to do is not do it yourself. David has graciously agreed to run through numbers with you for free. That's why he's here. That's why he's doing this deep dive. He did this for me, right? The deal that I did last year was $197,000 duplex, 2 single family homes, 1 lot, really small homes, like 600 square feet or 700, something like that. And again, it worked out, right? I think, again, these are rough numbers. 197,000 purchase price, minus land value was rough and tough 155. At the end of the day, he put 10 grand in my pocket. Granted, now I'm a real estate professional. I can use all of that. So this is why I made a video probably 9 months ago. I think it was with Omar, who actually introduced me to David, where I said, I'm not selling any more homes. I'm not flipping anything, right? I flipped 56 properties and I should have kept them all, because I should have used this instead of, flipping pride of ownership rentals. Because I live and learn. Yeah, I paid a lot of taxes. Darn it. But yeah, this does work, but I do appreciate it may not be for everyone. So let me talk about the process that I went through. Because again, if you follow me, I'm relatively cheap. I don't spend money easily. So I get introduced to David. I have a phone call, like what he has to say, want to test him out. I send him a duplex. I send him the address. I send him my closing statement. I can talk about when it went in service. When it goes in service is important, because that's when you can take depreciation. And he gave me a proposal. Proposal looked good. At that point, I signed a contract and I gave him half the money. They scheduled an appointment at my property. I have tenants in there because it was in service. So they took some pictures, did some measurements. I want to say 3 weeks later, I got a full-on report. The report, I actually had my accountant look at, gave a full thumbs up, paid the rest, good to go. So that was kind of my process. From the first phone call to saving money was probably an 8-week journey, right? Because again, some of that's on me for getting back and,
once we get the documents and the pictures, it normally takes about 6 weeks to get the study completed. Yeah. Some people are easier to get the information from.
Fair enough.
You were organized.
Yes.
Omar was too. Omar had all his ducks in a row and was easy. So we did 16 properties for Omar this last year.
That's perfect. So, that's crazy. Very, very cool. So let's, the other thing I want to talk about is short-term rentals. This was actually an aha moment for me. You and I did a series of interviews on my channel a couple of weeks ago, which you have your own playlist now. I think it's called Cost Segregation, something like that.
Hey,
yay.
I've made it.
You've made it. You're helping people, so you get your own playlist. Short-term rentals is interesting because, again, I'm always thinking about I'm thinking about myself, right? I have a real estate portfolio. I keep getting hammered by taxes. I can't write this off like I thought I could because I make too much money, blah, 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 blah. And then you drop in this short-term rental twist. And I think we need to hit it again. Because let's just say you're a lawyer, doctor, dentist, whatever, you make 200 grand, engineer, whatever, you make 200 grand a year. And you're not doing month to month, year leases. You're not doing passive investments, which is all I've ever done. I've never done a short-term rental, but I want to play this. I want to play this out because maybe this is an option for folks. Now, I would never do a business just because of taxes, but if you are doing this, you might as well use it.
Absolutely.
So if you're doing a short-term rental, and I think you have to actively be engaged. So let's talk about that. Give us samples of what you think active engagement looks like.
If you're the one who's booking the rentals, if you're communicating with the renters, if you're managing the cleaning crew or cleaning it yourself or doing whatever, whether it's an Airbnb or just a vacation rental you're doing yourself or whatever, that's actively involved. Just like any other business, you have to be actively involved in your business.
Now, just because I know the rules around real estate professional where people try to get in and document hours, is there an hours requirement or is it an activity based, or do you know?
I don't know for sure. I think it's activity based.
Okay.
If you are more involved than anybody else in your property,
that's the key. More involved than anybody else. I guarantee you that's
right.
So you don't have to actually do the cleaning, but if you're scheduling it, doing this, that, if you could show that it is truly a business, I do believe the IRS will be pretty picky on that. So talk to your CPA and get comfortable. But that could be a way, because again, it's not passive income, it's a business. And that's a subtle tweak. Not only does it go from 27.5 to 39, which is an issue, but because it is a business, you can take the write-off against ordinary income, which is interesting.
They treat those the same way they would treat a hotel.
Exactly.
As a business. Yeah. And because it's depreciated over 39 years, getting that depreciation accelerated makes an even bigger.
Yeah. Year one is even more important. Yeah. Year one's more important. So let's kind of paint a vision. Husband and wife, two-party system. Let's say the wife's an engineer at some tech company making a couple of $100 grand a year. Husband, I don't know, stay at home or watches the kids or is a teacher or whatever. The wife makes the money in this example, but they make more than the $150 combined. However, they have 4 short-term rentals. I just want to be really clear in this example. If they set it up in a way where the husband, in this case, does the majority of the work, and again, they can prove it, their account blesses it, they could, because it is a business, right? 4 is certainly more enough to qualify as a business. They could take advantage of this and then have it wash against the wife's income if there's a loss.
Well, I mean, because it's not considered the rental income on a short-term rental is not considered passive income.
It's active income. That's the key.
Active income. So any loss is an active loss, which can be, used across the board.
Yeah. So I want again, people following this. This is just 2 guys talking on the internet. I have done this. I have an accounting degree, but I don't do my own taxes. David's been doing these for years. He's helping people do this, but I would tell you to check with your CPA and I would ask him this question. If my short-term rental is, because again, your CPA probably doesn't know the difference. They probably look at an Airbnb and a month-to-month rental the same. I would go to my CPA and say, hey, I have a business that produces active income. It is in the short-term rental game. And I would have these questions. And if they don't understand, let me put David on the spot right now. This ought to be fun. So let's say there's a 1 rental at a time student or follower who's in the Airbnb business. They are doing the work and they can prove it to you. And then their CPA goes, I don't get it. Could they reach out to you and maybe get on a 10 or 15-minute call with their CPA to kind of
Absolutely. I do that all the time. What I will say, and this has been a common soapbox with me on videos with Michael, if you are investing in real estate, period, don't do your own taxes.
Yeah.
TurboTax is great. Don't use it. You need a CPA, and beyond that, you need a CPA who is very, very good at real estate investment. There are CPAs out there. They're all over the place. I have a number of them that I work directly with that specialize in real estate investors. They are not an expense to you. They are an investment to you because you will wind up in a much better tax place. They know the ins and outs of real estate investing and how it applies to the tax code. They will watch out for things with you. I will also say, any of my clients that I've done cost segregation for, I always mention to them, don't buy, build, or renovate without calling me, because I can help you structure any of that in the best way for taxes. And I'll work directly with their CPAs. I do it all the time. The CPAs involved in this, I may have to reach out to their CPA for questions. It's people who do their own taxes that don't know how to answer the questions right. They could get themselves in some serious hot water if the IRS comes calling and says, well, where did you come up with these numbers? And they say, I'm not sure.
Yeah.
Save receipts, keep good books,
yeah,
get a good CPA.
Yeah. This is the reason I did the deal with you, right? I spent money in getting this done is because you're going to stand side by side for me. I am one of those individuals that has been audited by the IRS. It took over a year. It was extremely nerve-wracking and painful. And at the end of the day, everything checked out. I owed nothing, got nothing back. It was I guess you called it a clean audit, but it was not fun. You do not want to use one of these cheap services that I see springing up that give you almost a TurboTax-like feel. Do it yourself. No, thank you. No, thank you.
And don't use a company that does not do site visits.
Yeah, you got to have the pictures. You got to get in the measure. It's real stuff.
Got to come out.
Yeah. Well,
I think you froze on me, Michael. I don't know whether I'm frozen or it's just you or everybody, but there we go. Yeah, you have to get out there and take pictures and measurements so that we actually know what's involved in the property so that it can be done correctly.
Yeah. So again, what I want to tell you, if you are in the short-term rental business and you're already doing it and your CPA is giving you a hard time about potentially taking it against active income, please set up a phone conversation with David. Don't call me. I can't do it. It's not my thing. That's what David here. One more time. What's your phone number to text?
And if I can't answer it, I have people who are tax experts at the company who we can defer to, and they can answer it for certain. My text number is 770-367-8091. Please feel free to text me if you'd like to talk about it, if you'd like to get a free estimate on a property, if you have a question, whatever. I'm happy to work with you and talk with you.
Okay, very cool. So let's keep going with the questions. Chester,
Sure.
let me see. Let me read it first and kind of peel it out. Actually, we can all see it. So do the depreciable assets. You can see the questions, right, David?
No, I can't see the question.
Oh, you can't.
I think if I pull up the chat, I probably can, but I can't see what you're looking at.
That's okay.
Okay.
I'll read it to you then. It's from Chester. Do the depreciable assets on 5, 7, and 15-year accelerated schedules renew when purchasing replacements for a property? E.g., for example, replace a door, light socket, etc. Do cost segregation analysis? I'm just going to finish. Actually, I'll stop there.
It depends.
Of course it does.
It does. If you're replacing capital improvements, now a light socket's not going to probably be a capital improvement. A door may not be a capital improvement.
Right.
We provide, and we are the only cost segregation company in the country, I believe, that does provide building system valuations to your tax professional so that they can determine in the future what needs to be capitalized and what needs to be expensed. Without getting into too much technical detail, this is because of the 2014 tangible property regulations that changed the way that stuff is looked at on how it's capitalized or expensed. And so they have to have a picture of what the building system itself costs. If what you replace is less than 33% of the total of the full building system, it must be written off the first year. If it's more than 33%, it must be capitalized. If that is significant enough, we could do another cost segregation study. But I got to tell you too, that once you've owned a property for a year, anything that you tear out of that property to do renovations can also be written off as a partial asset disposition. That's why I say before you renovate, call me, because I want to make sure not only you, but your CPA as well is aware of the fact that a partial asset disposition can be taken. That keeps you from depreciating two things. Let's say you have a property, you have an apartment building, and it has so many air conditioning units. You replace 2 of the 8 air conditioning units. That's going to be less than 33%. It can be written off. If you replace 6 of them, then it has to be capitalized.
Right.
But you're already depreciating the air conditioning units that were originally there. And to keep you from depreciating 16 air conditioning units when you're only using 8, you can take the value of those units that you take out all the way down to like drywall, the cost to haul it away, the cost to tear it out. All of that stuff can be written off and get you another good tax break.
Yeah. This is why you have to work with professionals, folks. Second part of Chester's question, do cost seg analysis have to occur annually, or is there a cost seg schedule which an investor could follow for preset determined number of years?
The cost segregation study is done once.
Correct. Yeah.
On the property. We give their tax professional a breakdown and new depreciation schedules to use on the property. Exactly. So you do it once and it's done unless you add on to the property or, do major renovations, build outs, whatever.
For most of you and me, it's a one.
Yeah,
it's a one and
it's
done.
once. Yeah.
How long is the turnaround usually for the service? You wanted to talk about that?
Turnaround usually, well, there's a certain number of phases, as Michael was saying. We do the free estimate for you, then you have to engage with us, and then we gather some documents and information, do a site visit. Once we get the documents and information, as well as the pictures from the site visit back, then the clock starts. It's what we call the study phase. The study phase normally takes about 6 weeks, could be as long as 8 weeks if we're in a really busy time, in tax time and that sort of thing. But 6 to 8 weeks is probably generally safe. We are still working on cost segregation studies for people who have extended their taxes to file in September and October. If you've got an extension and you need to file in October, we still have plenty of time to get, well, not plenty of time, but we have time to get it done.
Yep, sometime.
We have some time. Everything has to be into us by August the 15th in order to get it done in time for the October filing. So we've got about a month.
There you go.
To get all that stuff together,
There's
which is doable.
Yeah, this is a good question from Robert. I actually have no idea. I think I know the answer, but it'll be fun. Can you cost seg if you are renting out rooms in your personal residence?
Unless you have a very, very, very expensive residence, it's probably not going to be enough of a value. So the way that we do that is we'll say, what percentage of your property are you renting out? Is it 20%, 50%, whatever? So when we say the cost of a property should be $200,000, that's the percentage that you're renting out. Right. So if you're renting out 50%, unless your house is over $400,000, it wouldn't be worth even probably looking at.
Right.
Now, if you're living in $1 million house and you're renting out 50% of it or even 30% of it, it might be worth doing the estimate just to see.
Yeah. Yeah, what I would tell someone to do is basically take the square foot of the bedrooms and baths, which is probably what you're charging for, divide that by the total square footage, and see what the number looks like. If it's, again, you've got to get to that 200K number roughly. So,
and I'll help you figure it out if you want.
He's a nice guy. Text him.
I'm a nice guy.
He is a nice guy. You are. That's why you keep coming back. All right. Can you do a cost seg but not do bonus depreciation?
You can.
Absolutely.
Your tax professional can elect to not use the bonus depreciation if they so choose. If that works out better in your circumstance, they can certainly do that.
Yeah. Yeah, I guess there'd be reasons you might think about that, but yeah, you could. Yeah, you don't have to. But yeah. Hey, yeah. Sam. Good morning. Net operating loss carry forward or NOL. Yep. For the illustrated example, what are the ballpark income reduction losses before multiplying tax rate to get the benefit? Looking for ballpark percentage 5 to 7 year property do you understand that question? I can try to read
Generally,
Let me read it again.
ballpark income reduction,
I got lost.
that I probably can't tell you, but it's generally, for our estimate, we take about 18% of the value of the building as 5-year property, and a few more percentage as 15-year property. Now, we try and shoot our estimates low.
Mhm.
So what I give you on the estimate, hopefully, is the bottom line.
Mhm.
Hopefully, it'll come out 10% or more above that in your tax benefit.
Nice.
Because I like calling people saying, hey, we got more than we thought, you know?
Yeah, I got you more money. Yeah.
Yeah.
So I'm going to try to say that's Yunzo. What I would do is reach out to him, give him an example, because it's really hard to.
Yeah.
Yeah.
And the best way to do it is to run that estimate on a property, and we'll see.
Yeah. And again, it's free. He'll do it free for you.
Absolutely.
Yeah. So Tamika emailed my CPA to request a meeting to discuss cost seg. Cool. He responded that it's a workable strategy that sounds good, but has some downsides too. Are you aware of any negative implications? I plan to call you. So she's going to call you.
Okay. Yeah, there are no real downsides to it other than if you plan to sell your property within the next 3 years or so,
Yeah,
there's going to be a lot of depreciation recapture. You're going to wind up paying a lot of it back. There's depreciation recapture any way you go when you sell a property. But there are ways to mitigate that as well, and ways to get around it. Not totally, but to minimize what it would cost you. Some CPAs are worried about audits. I can tell you that our company is the largest cost segregation provider in the country. We have done over 30,000 studies, and that number is continuously growing. But we've done over 30,000 studies in all 50 states and never once triggered an audit. In the few times that a client has been audited about something else and the study was called into question, we will defend that study at no charge to the client, to whatever extent is necessary. And in the few handful of times that that's happened, we've never had the IRS make a change to our study.
This is why this is why you don't do it yourself stuff. I mean,
exactly. If you were going to have brain surgery, you're not looking for the cheapest doctor.
No, having gone through a year-long audit with the IRS, I want somebody that stands next to me. So yeah. So again, I want to second this. I want to second your caution for Tamika, because I agree with it. If you're in an asset and you're going to be in and out of it in a couple of years, I would not do a cost segregation. The upside in year one for the downside in year two, meaning cost, it's not worth the energy, in my opinion.
Unless you just need an interest-free loan from the government.
Yeah. Yes. I mean, if it's big enough, sure. But let's be real. I don't think, like, again, something like if I was going to flip $1 million house or whatever, in the time, or it has to be in service. So that actually wouldn't work. Maybe in an apartment building I don't know. I don't think I would do it. If I was going to get in and out in a year, honestly, I wouldn't do it.
Now, the standard that I use generally for people is 3 years. If you're going to keep it longer than 3 years, there are some good reasons to look at it.
Yeah, I might say 5, but sure, 3 to 5. Yeah. Yeah, but for most of the people that follow me, we're buy and hold, keep forever. So then it's definitely out there for you. So Chester asks, what are all the documentation is necessary to complete the cost seg? So actually, why don't you answer that in 2 steps? How do you start kind of phase 1? And then if they approve it, what do they need for phase 2?
Okay, so to run an estimate on the property, what I need is, and I can send you this list if you just contact me, but I need the legal owner of the property. It may be in an LLC or it may be in your name, and just whoever the legal owner of the property is. I need the type of property. So is it a single family home? Is it a duplex, triplex, quad, apartment building, commercial building, whatever kind of a commercial building? Is it short-term or long-term rental? I need the address of the property. I need the cost basis of the property. Now, if you just purchase the property, the purchase price is fine as long as I know that it includes the land. And I need the date you placed it in service. The date placed in service is not the date it was first rented. The date was the date it was first available to be rented. And generally, when you advertise it for rent, that's a good benchmark. If the property was not purchased during the tax year that you want to use the study, the federal depreciation schedule from your previous taxes would be very, very helpful. If you're going to do that, contact your tax pro and just tell them you need the federal depreciation schedule. They can put their hands on it in a second and just email it to you or email it to me or whatever. It's one page. It shows me the breakdown between the building and the land and the date you put it into service and all of that kind of stuff. So yeah, so that's what I need to do the estimate. Estimate takes about 2 days and I'll have the estimate back. It'll show you exactly what the cost is. That won't change. And it'll show you the approximate tax benefit. Again, we try to shoot about 10% low if we can. If you then engage us, like Michael said, you pay 50% deposit and then we request documentation. So what we need is a confirmation of the cost basis without land. That generally comes from your tax professional. I also will send a video to show you how to figure it out using the county tax assessor's website. We need, if it's a newly built building, we need all your cost documents, your AIA documents or whatever that show the cost to build it. We need blueprints if you have them. If you don't, that's fine. We need an appraisal if you have it. If you don't, that's fine. We need to do the site visit, take pictures, and then if the property was already depreciated straight line for 1 or 2 or however many years, we will offer to fill out the necessary forms for your tax professional that the government's going to require. It's called a Form 3115. From what I hear from all of my CPA partners, it is a major pain to fill out. So we offer to complete that for them. All they have to do is sign it at no charge. For that, we need an information form back from them. There's no big rush on that because we can't really start on the Form 3115 until the study is completed. So that's it. And once we get all of that, as well as the pictures and things from our site visit, we're off and running.
Very cool. Awesome. Very complete answer. So really 2 steps there. Sam, can you do it anytime after your purchase?
You can. If you purchased over 15 years ago, probably not worth doing.
Yeah.
But yeah, you don't have to do it the first year, although the biggest benefit to you is going to be in your first year.
Correct. Would it be useful for a single family rental?
Absolutely. I do them every day, all day.
Yeah. See the examples from earlier. All of those were single family. Well, actually 2 were single family. 1 was a condo technically.
Yep.
A bit more technical here. The nulls are all above the line deductions, right? Nulls?
Net operating losses are all above the line deductions. Yeah, it's not a tax credit. It's just a deduction.
Yeah, straight deduction. Yep. Okay. You hit it on the head. Okay, cool. Can you do a cost seg study in 2021, but take depreciation in 2022?
Well, you have to take depreciation. You have to take depreciation as soon as you place the property in service.
Yeah, I want to hit that again. It is a requirement by the IRS that when you have a building and it's in service as a rental, you must take. It's not like you can choose not to take depreciation. You may choose straight line. You have to choose something.
So what I would recommend, if you've got a case where you put it in service in 21, you can do the cost segregation in 2022 and then take the bonus depreciation.
Yeah, you're taking the bonus depreciation. Yeah. So if this is why you should not do your taxes yourself. You must take depreciation. Yeah. So,
yeah, and I have run into a number of cases where they did not.
So have I. Yes.
So we can straighten all that out for them if they need it done.
When house hacking, can you cost seg common areas like lawn, driveway, common entrance, shared laundry in a basement?
No,
because you
can only cost segregate the part that is rented out.
Correct. Yeah, because again, your usage. Yeah.
Right.
Yeah. On a new purchase, does the cost seg breakdown have equal personal property at full 5 or 7 years remaining, or does it use remaining useful life of each item instead?
I'm not sure I totally understand the question.
Let me try it one more time. On a new purchase, okay, so I just bought something. Does cost seg breakdown have each personal property at full 5 or 7 years remaining, or does it remaining? Oh yeah, it doesn't look at useful life. It's just like if you bought a building, David, that had a old AC on it, or
No, it just uses it. It
Just
starts the depreciation fresh.
yeah, correct. Yeah. What if you have multiple properties, but they are less than 200K? Does it still make sense? If so, what does the ideal? Oh, like if you were doing a portfolio, or because it only goes against one property at a time. It's not a portfolio.
Each property is depreciated separately. So each property would have to be above that line.
Yeah. If you were buying
to make it
50K,
work.
if you were buying 50K homes in Detroit, and even if you bought 100 of them, this really, I wouldn't.
You're going to wind up paying more for the study than the benefit you're going to get out of it, which I won't let you do.
Yeah. Don't do that.
It's just not right.
Can you do it in a house where you rent by 6 rooms to unrelated individuals and it's not owner occupied? Well, that's just a rental, right?
Yeah. It's a sixplex.
It doesn't care how it's producing income. It cares if it's your home, right? Because owner occupant bad. But yeah, if you're renting to, like if you had a 6-bedroom house and you were renting to 6 roommates, it's a rental. It doesn't care. It doesn't care what the lease is, right? If you have 6 leases versus 1, it doesn't care.
Right. And, if it's long-term, it's one way. If it's short-term, it's another way, but it still works.
Oh, very cool. Well, look at that. We got to the bottom of the questions.
Good questions too.
So I'm gonna run for 3 or 4 minutes. If anybody has more questions, get them in there, because I did allocate 90 minutes. If we only use 60, it's totally fine. So here are my kind of wrap up thoughts. First and foremost, cost segregation is something that the rich use. It was first put into place by somebody buying office or hotels or something. Cost segregation services, David's company, brought it to mom and pop investors like myself. I've known about it. I studied it in school. I get it. I never thought I could use it. We did a duplex together. Very beneficial. Seamless process. The free quote was easy. I texted him. I everything that he says you'll be doing, I did. I got introduced to him via Omar. I texted him and said, here's the address. We had a quick phone call. A couple of days later, after I gave him that, he brought me the summary. He says, here's the numbers. I said, I like it. I credit card charged half the fee. 6 weeks or whatever later, I got it. I paid the rest. About, 60 or 90 days later, I brought it to my CPA for filing taxes. Crystal clean, quick. And, I saved 10 grand, like in real cold hard cash. The thing I like about David, and I've had people reach out to him, if it doesn't work for you, he's going to tell you.
Absolutely.
And again, based on our playlist on my channel, there are some subtleties around Airbnb and VRBO that I do not appreciate, nor do I understand, but he does. Is it a business versus passive, active versus passive? I suggest folks that if you're in the active world, which is Airbnb or VRBO, and your CPA is just not getting it, have a call with David and your CPA. You might as well see if it makes sense. This is I hesitate calling it a loophole, because it's not really, loophole has a bad connotation. But if you are running a business and short-term rentals are declared a business, it's a mistake not to do it. So,
and if you are trying to do it yourself, if you've tried to do it yourself in the past, or you have a CPA that either doesn't understand real estate or has some negative ideas about cost segregation, talk to me and I can refer you to some very good real estate CPAs.
Yeah. So one more time, just because a lot of people will be listening on the podcast, what is the number you want them to text just to get this whole started?
Text me at 770-367-8091. And I will respond with a link to set up a phone call with me.
Cool. All right. So let me just go.
Give me your name when you do.
Yeah, please. First name would be great.
And tell me that you're from One Rental at a Time, because I take special good care of people.
Yes, you do. I have great feedback. So thank you. So let me just go through and see if there's any more questions. Else we will call it a day. Sean, thank you both for the information. Sean, you're very welcome. David, I want to thank you. It's been wonderful. Very informative. We'll reach out. Cool. Bought a duplex for 1.4 million. Damn, that's an expensive duplex. In 2019, in the process of converting it to a fourplex. Sounds interesting. That's all that's said, but I'm going to guess you have some thoughts on that.
It's more than interesting. It's important. Give me a call.
Yeah.
Text me. Let's set up a call.
Yeah. You got some money that could be had there. Although it has to be in service. I hope it's not vacant. Yeah. In the event we do purchase more equipment than could be capitalized, would you also charge for, Chester, you wouldn't be doing a follow-up survey. That would be done with your CPA. If you bought.
Well, no, it may not
No?
be.
Okay. Go for it.
If it's significant enough.
Define
then
significant enough. So let's say it's
Over
my 200K duplex.
200K. If you do more than 200K in
Okay.
capital improvements, let's do a follow-on study. And I can tell you that the follow-on study for the same person generally and the same property is generally a little less expensive than doing the initial study.
Yeah. So let's just do a for example. Let's say I have a $2 million apartment building, and because I do, and I'm putting on a 50K roof. That doesn't meet the 30% that we talked about earlier.
Well, it has to be 30% of the roofing systems.
Of the roofing system. There's the subtle tweak I missed.
Now, understand too that each building is considered a separate unit of property.
Mm.
So chances are you're going to be capitalizing that roof.
Yeah. That's what my CPA told me to. I called him.
Yep. And we can do a follow-on study for stuff.
Yep. There you go. Tamika, awesome stuff. Thank you. Information. Any more questions? Awesome. Okay, cool. We've got all the questions, buddy. Thank you very much for your time. I appreciate you, David. Folks, I used him. I wouldn't bring him here if I hadn't tested him out first. Just like Stephen Dow, I used him. He got me 30-year money on apartments. That's why he keeps coming back. David, thank you for your time. You have a wonderful day. All right.
Anytime, my friend. And if there's any other questions, feel free to reach out to me.
All right. One more time, your phone number to text.
770-367. I got to make a little sign.
There you go.
770-367-8091. I'm in the metro Atlanta area, but I work nationwide.
Thank you, buddy. Take care.
My pleasure.